This conference will now be recorded.
For this supplemental video covering what we would have or did cover in week 3, what the best way to do this is to not simply go through with me and write down the answers as I'm providing them, is to do it as we would have done in class, which is take the first 2 and try to complete them after I've kind of explained what we're going to do, and then pause the video. And then I'll wait a few seconds and I'll go through the answers. And we're going to do that as we go on through each of the 6 or 7 adjusting entries. And then we're going to, in the next video, we're going to move on to combining, adjusting, and correcting entries, which you should have already had a sample of in the before week 3 lecture, part 2. So with this example with the Boats R Us, we have 6 different adjusting entries that we need to do at the end of the year. Remember, adjusting entries do not involve cash. They are items that we have to remember to do that aren't necessarily obvious, but for accrual accounting, we have to update our revenue and expenses when they occur, not when cash is paid. So what I've also given you here, so here's number 6. Number 7 is your opening T accounts. Think of these as your ending balances. So at the end of the year, we would have had a whole bunch of cash accounts and the final balance was 4,000. So I just put that first instead of having all of the balances. So therefore, you're not going to necessarily find a credit for 4,000 somewhere within the T accounts to show an offset. That's not how this one is working. This is our final balance. Same way with anything else here. Revenue, we didn't have just one sale of 12,000. We had lots of revenue sales that added up to 12,000. So we're going to be using these T accounts to update and perform our adjusting entries. Okay, so with that, what you should do at this point is pause the video. Use this T account. You should have it printed out, or you could type it in, I guess, and update the first 2 entries from what we had finished up on in week 2 with the practice. Go ahead and do that now. Okay, the first entry deals with we have used our equipment for another year over the equipment's 10-year life. So this is the 2nd year. When I go to my T account sheet, you might wonder, why is there no depreciation expense for year 1? And if you remember back from week 2, I had briefly talked about these accounts over here, they revert to 0 at the end of each year. And we're going to talk about that in week 4, what happens to those accounts that get closed. But for right now, just the understanding that at the end of last year, my depreciation expense went away. And so it's at 0 again. However, it's opposite account, I guess, the contra account over here in the assets. This is an accumulated account. It doesn't get rid of its balance. So we had 1,000 from last year, and it carries over. Anything in the assets and liabilities and most of the owner's equity accounts get carried over year to year. They don't go away. So this tells me I've used 1 year of my equipment so far. Now I'm ready to put in my 2nd year. So 10,000 divided by 10 is 1,000 a year. And if you remember, we're going to have a new T account called depreciation expense. All this means is that I used my equipment for 1 more year. So I've got to show that I got the benefit of it. And then my corresponding account goes to the contra, and I'm crediting my accumulated depreciation, which brings down the total value of my equipment. The book value of my equipment here is 8,000 now. That's how much I have left to use and depreciate. Notice I did not put the 1,000 over here. If I put it over here, it makes it appear that I sold the equipment, and that is not what happened. All I've done is used it. So once you get the T accounts updated. Now we're ready to do the journal entry. So make sure you have your journal paper out as well. You do not want to bypass this part. You need to get the journal entries, the adjusted journal entries going. Don't try to do them all at the end. Okay, so hopefully, again, you had the first two done. So let's go to the second one. Back to our work. Wages have been worked. The employees have done their job, but we haven't paid them yet. If they've done their job, that means that I've got a benefit of that. The company got a benefit of our workers working. So we're going to have to come down here and say, okay, we've got wage expense already of $4,000, but now we're going to up it. Now our wage expense is at $4,000 plus the new $2,000 that the employees just worked. So we have $6,000 of employee work that was done for us. And then it says it was accrued and it won't be paid until early next year. So when it's accrued, we need to show that I owe the money as a wages payable. Do not take it out of cash. It's not been paid as of December 31. We owe the money. Okay, so now go ahead and pause and do steps 3, or actually go ahead and I would go ahead and finish it out. 3, 4, 5, and 6. 4 and 5 are very similar. So 3, 4, 5, and 6, and then here in a couple seconds, I'll go through the answers. Okay, with number 3, services performed for Sally are complete. Well, okay, it doesn't tell us any amounts. Well, we can look to our T accounts to figure that up. Most of the time, our T accounts would say this certain account dash Sally, but I didn't want to make it that obvious. I wanted you to figure up what account shows that we owe Sally work. Well, if we owe anything, that has to be a liability. So when I come over to number 3, I know that my liabilities are going to be affected, and I'm going to want to come down here to the unearned revenue for Sally. It shows here before I do my adjusting entry that I owe $2,000. Well, it says they are now complete. So my debit question, what did I get? I got a reduction on what I owe. I don't owe her anything. So I can debit the $2,000 to get this account to 0. And then I'm going to credit the $2,000 over here to show that the work was done, and I can now count it as earned revenue. So now my revenue is up to $14,000. Cash wasn't collected because cash had already been collected at some previous time. Think of it like a gift card. This was just the service actually being rendered when cash was paid a long time ago. With number 4, prepaid rent was used this month. So I need to look, and yep, I do have prepaid rent. I have 1,000 of it, so I actually have 2 months worth. Well, it tells me I'm using 1 month. So the question is, the debit question is, what did I get? I got the benefit of renting a building. So I'm going to need to up my rent expense. I'm going to come over to my rent expense and increase it by 5,000 or 500. And then where that 500 came from, I didn't pay for it again. It came out of my prepaid account. I no longer have 1,000 in prepaid because I just used and got the benefit of some of it. So now I only have 500 left. I have been neglecting to put the journal entries up. Let me go back to number 2. If you haven't updated the journal entry, go ahead and do that now. We should have done this as we were going. I just spaced it for a second. So pause the videos if you need to have a little bit more time to write them down. But I'm going to keep moving for those that write a little faster. Number 3, remember we had debited the unearned revenue and credited our service revenue. Now I'm going to go ahead and put up number 5 as well in the T accounts and then do 4 and 5 together. since I have these on the same screen. It tells me here on number 5 that the entire prepaid advertising was used. So we had 500 in prepaid advertising. All of it was used, so I need to get rid of it and show that I got the benefit of advertising. I didn't have a previous T account for advertising, so I need to make one. So I debited what I got the benefit of. I got the benefit of getting advertising and crediting where it came from, which is my prepaid advertising account. Here are my 2 journal entries to show that the rent was used, or rent got the benefit of it, and I got the benefit of the advertising. And they both came from their respective prepaid accounts. Again, keep pausing the video as you need. Number 6, our final one, before we do an adjusting trial balance. Supplies remaining after physical count was $300. All right, before we get to that adjusting entry, let's look at what my supplies were before what we went and counted. When we originally bought them, we had $900 of supplies. It tells us now we only have $300. So that means we got the benefit of $600 of supplies. I already have a supply expense, so I'm just going to be adding on to this $1,000. I'm going to be adding on another $600. I add on $600 to my supply expense, and then where did it come from? It didn't come from cash. I didn't buy anymore. It simply came from my supply account. So my supplies are now at $300 remaining at the end of the year. Here's my journal entry to show that I got the benefit of the supplies, my supply expense, and crediting the supplies. As this is the last entry for this example, we are now ready to go ahead and total T accounts. You shouldn't have anything in the cash when it's only adjusting entries. So we're going to total up any T accounts that need it, and then total our parent accounts and make sure that this side over here does in fact equal 14.8, my assets. And I did that using the Excel method with formulas, showing that this plus this plus this minus my expenses. Yep, it does equal 14.8. So somewhere on your sheet, you need to show that actually written out that you added these all up and subtracted the expenses, and you did get 14.8. At this point, we're ready to do our step 4. So if you remember the four steps that we have as of this moment, the journal entries and the T accounts are steps 1 and 2. You can do those in any order, T accounts first or journal entries. Then we go and do the adjusting entries, and then now the adjusted trial balance. The adjusted trial balance is nothing different than the regular trial balance. It's just the adjusted trial balance includes all of our year-end entries, all of those adjusting entries. That's why it's simply called the adjusted trial balance. It's the final trial balance of the month or the year, whatever we're talking about. Has the same principles that we need to apply. All the accounts need to be in their proper order with their final totals in either in the correct normal balance of that account. So we got all of our debits. And then remember, this is a contra account. I should go back to this. When we get to 14.8 for the assets, that's why I had put this one in red, because this is a contra account. So it's a negative 2,000 because it's a credit balance. So if you were getting 18.8, that would be why. You need to subtract the 2, not add the 2,000. So here's what our adjusted trial balance looks like. We've got our appropriate title, what it is we were working on, and the date. The as of, remember that means just for this year. And then this is a personal preference, but I like to have a line in between each of the parent accounts. So all of my assets, then my liabilities. I didn't put one here just because there were so few. And then all of my expenses. And then the final thing, once we have them all in order, our debits better equal our credits. If they don't, then something is wrong. Okay, that is where we will end this video for our Boats R Us example. In our second video, I will be going through the Julie's example with adjusting entries and correcting entries.